Last week I attended the ETF Bootcamp hosted by Tom Lydon and ETF Trends. This is a conference that's focused on the growth of ETF industry. It helps new issuers connect with custodians and various other service providers and helps existing sponsors grow. I was actually very happy to be a judge on their ETF Shark Tank panel where I got to evaluate new issuers that have some great entrepreneurial ideas. So as you can tell, call it optimism was a big part of this conference. However, the investors themselves still have quite a bit of anxiety. 2016 has been a unique year. We started with a lot of volatility, big drawdowns in January and February. The market subsequently recovered, and then August we had less volatility than we've seen in many years. So what happens next? Well, we've got an election that creates uncertainty. We've got interest rate issues that create uncertainty. We have the knowledge that the Fed is not going to help anymore. So we thought today, with that uncertainty, we would talk about ETFs that protect you on the downside. ETFs that go up when the market goes down. So traditionally there have been two that people really go to. It's first the inverse ETFs. These are ETFs that are 2 times inverse, 3 times inverse, 1 times inverse, but essentially they go up when the market goes down. And despite what anyone tells you, they do work. They're just not buy and hold vehicles. On a day-to-day basis, they're gonna do exactly what they say they're gonna do. Except you have to know when to use them. VIX ETFs is the second one. The VIX is a measure of volatility. It has a very high correlation to, or inverse correlation to the markets, and it's got more delta, meaning when the market goes down, it tends to go up a lot more. They have similar problems as the inverse ETFs, and they are definitely not a buy and hold vehicle either. So let's go with the idea that we've used for the last couple of years to protect our portfolios. It's a product called BTAL, B-T-A-L. It's an ETF from QuantShares that in a very institutional way takes the high volatility stocks of the S&P and shorts them, and takes the low volatility stocks in the S&P and goes long them. The end result, as you can see from this chart, is the index has done very well of giving you a return when the market goes down. But more importantly, we believe this can be used as a buy and hold vehicle because it has what's called an asymmetric risk return property, meaning when the market's gone up, it has gone down, but not on a 1-to-1 ratio. And when the market has gone down, it's gone up close to a 1-to-1 ratio. So you're getting risk protection, but you're not paying the exact difference on the other side. Thank you very much.